All right, let me start here again at the cost principle. In accounting, we use what is called the cost principle, where we record when we purchase things only at cost. We don't use market value, we don't use theoretical value, and sometimes this creates problems. It is the most conservative method, but it doesn't necessarily actually reflect the right value in the accounting statements. And the reason for this, there are analysts who will take up these discrepancies and report for them. But it is the most conservative, and we do use that in the accounting field. But let me give you an example of one of those issues. What if you were a railroad company and you bought 400 acres of downtown LA 100 years ago? You would show it on your books today at that cost. Yet it could be worth literally billions of dollars today. But that's not what's shown on the financial statements. You only show it at cost. And so there can be a huge difference between cost and market value. But we do only use the cost principle in accounting. Revenue recognition and the matching principle go hand in hand. And what this states is that revenue is recorded when it is earned, legally earned, not when it was paid, not when it was billed. And the matching principle says the same thing for expenses. You record expenses when legally incurred, again, not when billed, not when paid, but when legally incurred. And this can create problems for accounting professionals in companies, because oftentimes toward the year end, there'll be a lot of financial monkey business going on because managers maybe want to meet goals or reaccount for information, and they'll try to stretch these very two principles, especially if they're trying to maybe meet goals where they can get extra bonuses. And it can create some major problems for accountants, because you've got to hold the line here, because if not, you literally can go to jail here. But it can create tremendous conflict between you and management, as well as some ethical and legal choices that you need to make. Full disclosure principle requires that we report in the financial statements anything that would impact a user's decisions. But what we don't define legally is what's material. And so in that case, they cover everything. And case in point, you can look at General Motors' annual report. Annual report is about 250 pages long, and probably 220 of those pages are the notes to the financial statements. It goes into exhausting detail. I personally think we would be better off using the market as a guide. Let the companies state what is material, like maybe within a quarter or 0.5% of sales, and if the market doesn't like it, they can lower the stock value, and then management will have to make a decision to increase that level of materiality. But now we don't use the market basis, we use regulators, and to protect themselves, we go to an exhausting detail in providing that full disclosure. And again, management will always try to put a spin on it that puts it in the most favorable light, and that can create problems for you. Accounting assumptions: for the going concern, time periods, separate economic entity, and the monetary unit. The going concern, when we look and prepare financial statements, we're making the assumption that this company will continue in operation for at least the next year. If not, we have to disclose that, because that could be a material impact to our lenders, other stakeholders, like regulatory, taxing authorities, as well as the investors. And so we're making the assumption that this business will be going for another year. Again, if it is not, we do have to clearly disclose that. Time period assumption: we divide the life of the business into monthly, quarterly, or yearly time frames. Monthly is usually used for internal users to measure so they can use it in making management decisions of how to run the company. The SEC does require for publicly traded companies to report quarterly and yearly. Please understand, when they're reporting yearly, that there are two types of yearlies. The first one is called the calendar system, and that's calendar period is starting, as it suggests, January 1 and ends December 31. The other part is that companies can choose when their year end. They don't have to be December 31. They can choose June 30th, March, or April, or September. point, the U.S. government itself chooses June 30th as their year end, not December 31st. And if they do that, that is known as a fiscal year, not a calendar year. So you'll see that terminology from time to time. Economic entity, we are going to separate owners from businesses. We don't commingle funds here, although many times, especially in small businesses, they will treat it as one and the same, that the business is their money and so forth. But not in accounting. We have to separate our reporting from the owner's statements itself. Monetary unit assumption. This is a troubling area, in my personal opinion, for accounting. And what this assumption says is that we have to state the financial results in a monetary unit, and obviously in the United States we use the US dollar, but in other countries they'll use that denomination of currency that they use. And the problem is that we are assuming that this unit of measure stays constant. In reality, it does not. Case in point, we've had major currency defaults throughout mankind's history. Remember during World War I, Germany in 1923 had a complete financial collapse. But we don't have to go far back in history. Case in point, Argentina collapsed in 1992, Mexico in 1994, Russia in 1998, Turkey and Romania in 2005. I think Zimbabwe and Venezuela is on its way to devaluing their currency. The most classic case, though, in recent times was Zimbabwe. Zimbabwe is a country in Africa, and a ruler by the name of Mugabe got in power like around 1980. And at the time, the Zimbabwe dollar, a loaf of bread would cost $1.25. Before it collapsed in 2009, that loaf of bread would cost $12.5 million. And as the accounting industry, how do we reflect that variation in value? Case in point, let me give you another example here, would be here's the US dollar. And this is a 25-year chart. As you can see, this is not stable. This value has fluctuated greatly over the 25 years. And I think this is going to be a growing problem because in the world, there are two types of currencies. Historically, there's been what's called the commodity-backed. That means your currency was backed by some physical commodity, more often than not gold. But it could be cattle, sheep, wheat. In the old Roman days, Romans were paid in salt. Hence the term that maybe you've heard is the guy worth his salt. That's where it came from those ancient days. The other form of currency is called fiat currency, and that's where a currency is backed by the promise of a government. Unfortunately, with fiat currency, every time they have gone to fiat currency, it has eventually led to a collapse 100% of the time. And the reason why is eventually politicians abuse their power and their right, and they abuse the currency. Sometimes this might take hundreds of years to occur, but eventually it generally leads to total collapse. Well, we're in a unique period of human history. All the major currencies today are fiat currency, which does not have a good track record. The U.S. got off the gold standard around 1974 and has become a fiat currency. And our government is devaluing that. Here, let me just show you a chart of 3 days of currency. Does this look stable to you? But the accounting industry has trouble in dealing with this and reporting this, and I think this is going to be a growing problem in the years to come because, again, worldwide we've gone completely to a fiat currencies throughout the world, and the politicians worldwide are using that system. Let me blow this up. Business forms. You have to spend some time. You're going to see this throughout your accounting career. This takes the legal form of the various business forms that a business can form. You need to understand the major advantages and disadvantages, you'll see this on the test, of the different business forms. For instance, sole proprietorship. It's the easiest to set up. It's where only one person owns the business as their own business. The advantages there is that you're taxed at the individual level. The disadvantage is you have unlimited liability. For instance, for many years, one of the largest companies in the United States before it was sold was 7-Up. It was not 7-Up Inc. It was just 7-Up. One individual owned that company. But again, by unlimited liability, let's say, for instance, one of his truck drivers killed somebody, that individual who owned the company could be sued for his personal assets. And many people do not like that legal risk, and so they go ahead and form other forms of business. The second one being the partnership. Partnership is 2 or more people come together as a general partnership. The advantage is that, again, you're taxed at the individual level. The major disadvantage is, again, unlimited liability, and you could be liable for what your partner does. I myself don't like partnerships. I think most people get into it too easily and don't think of all the ramifications, and I think you need extensive legal documentation when preparing a partnership. A corporation, this is what you see like on the New York Stock Exchange. Companies incorporate. It's a separate legal entity, and you do have to file a state at the state level for this corporate ownership. Usually you'll see, not usually, you will always see when a company is a corporation, the symbols Inc. or Incorporated or Corporation at the end of its name to signify a corporation. The major advantage of a corporation is that you have limited liability. Here, the company can be sued, but not the owners for any kind of damages. The negative, though, is that there's double taxation. And what I mean by that is the corporation must pay taxes on its profits, but when it rescinds its profits back to the shareholders in the form of dividends, those shareholders have to pay taxes again on that dividend income, so there's a double taxation. The hybrid is a combination of like partnership and corporation. You're taxed at the individual level, but you do have some protection as a corporation. This is usually what you see like for professionals like doctor groups and dentist groups and so forth. One area that's growing tremendously fast is called the LLC, the Limited Liability Company. That is comparable again to like a partnership and corporation. There's a lot of tax advantages. I could spend a whole semester just talking about the legality of this area. Again, just learn the basic advantages and disadvantages for the test. I'm going to stop here at this level, and I'll start with level 3 in another video. Thank you.